What is the gold price at the moment most correlated to? Currency, inflation, actual economic data?
Right now, in the recent week, we're seeing certainly the dollar be a big driver for gold, and as well as we've seen real interest rates, which historically is a big determinant of gold prices, come down, a little bit, and that's been a big boost for gold. Overall, we've seen investors as well, move back into gold, and I think that's been a big factor that I think will sustain a rally throughout this year.
The dollar itself, despite equities rallying significantly because of a more dovish tone from the Fed, was only down 0.7% in January. Why wasn't it down more, and what do you expect with this softer tone from the Fed for the rest of the year?
Well, I think it's important because the Fed is much more dovish in their commentary, and I think a lot of market participants were expecting 1, maybe 2 hikes this year. Now the market is pricing in basically 0 hikes this year. So with the Fed on pause, that's going to put a cap on real interest rates, and I think that certainly is good for gold as we're seeing rates moderate and potentially come down. And I do think especially if inflation picks up a little bit, we'll see real interest rates come back in, and that should help boost gold even further.
Darrell, we've got the jobs number coming out. What's your sort of summing up of where the economy is relative to expectation? I guess part of the other reason why the dollar hasn't been softer is poor data from the rest of the world.
Yeah, that's exactly right, Wilfred. I think as it relates to this morning, we think the jobs number probably comes in a little soft, around 155. Some payback from a big December number. I think what's interesting, if you watch the jobs data here, not just this morning, but over the next coming months, is we've seen the biggest decline in some of the ISM data. So manufacturing had its biggest decline in the entire cycle last month, and yet the jobs data had its biggest beat last month as well. Typically, if you look at ISM, you get a 2 to 3 month lag into the employment data. So I think next month and the month after that, you're going to see some softening in the labor market, which I think the market will be fixated on, and frankly, the Fed needs to pay attention to.
And in terms of how you're allocated at the moment, defensive like gold, or happy to have U.S. equity exposure at the moment?
It's a unique environment right now. Literally just yesterday, we went underweight small cap after an 11% month in January. We think the earnings are out kind of over their skis on valuations at today's levels. We see some mild upside in the U.S. We've got a 2,800 to 2,850 on the S&P. But what's really interesting and nice, I think, coming into January is you're getting this breadth expansion in the markets, right? So remember, for this entire cycle, it's been all about tech and discretionary and all that stuff. Now you're seeing industrials lead. You're seeing financials and banks do better, right? That's healthy for the markets, healthy for the economy.